Good morning. Today we are going to start our next class on management accounting. Now, the next chapter depends on, and the next part depends on, next part is the balance sheet analysis. A balance sheet analysis, it depends on elements of the balance sheet. Now, first we must know what does a balance sheet specifically look like. So we must first discuss the elements of the balance sheet. A balance sheet is one of the most important financial statements. To understand a balance sheet better, let us take a look at the elements of the balance sheet. As you can see, the balance sheet shows all the assets on top and then all the equities, the shareholders' equity below the assets. Now we are talking about a single column, not a double column balance sheet. That is not a single column balance sheet, which one shows the asset and the other shows the liabilities. We are not talking about a double column balance sheet. Now we are talking about the elements of the balance sheet. Now, on the one hand, we have the asset side. Now, assets, as we know, what are assets? Assets are things that the company, the proprietor, or any business entity they own. Means the section of the balance sheet tells what kind of assets the company owns and the value of these assets. Assets can range from land, from building, from furnitures to computers to things such as patents and all that. Now we have these are the assets of the company. Some assets are capital in nature. That means they can be used to, mean such as machinery, which can be used to produce a further revenue. Now, but some assets such as sales, such as debtors, etc., are obtained from the sales. They're obtained from the normal activities of the business. Now, in elements of the balance sheet, we have first the current assets. What are current assets? Now, normally current assets include cash, accounts receivable, market securities, inventory, and prepaid expenses such as taxes and insurance. These are the assets that can be converted into cash in the near future, usually less than 1 year. So current assets are those assets which can be converted into cash within 1 year. Now, they include cash. Cash means both cash in hand and cash at bank. Because normally in today's business, we generally don't use much of a cash. Accounts receivable. What are accounts receivable? Account receivable are the credit sales that we have made and the debtors that we have to pay from whom we have to collect the money from the credit sales that we have incurred. Now the credit sales the debtors are divided into 2 or 3 categories. Say within 30 days they are termed as 100%. If we make a provision for bad debts, they are termed as 100% recoverable. Up to say 60 days they're considered as 75% receivable. More than 180 days they're considered as the provision will be considered as maybe 100% not recoverable, and so that amount is deducted from the accounts receivable portion or the debtors portion. Now you have marketable securities. What are marketable securities? Marketable securities are short-term investments. For example, there's an excess of working capital or there's some excess cash in the company, and the company decides to invest this in short-term bank deposits or in other deposits for 70 days to say 30 days or 45 days and earn some amount of interest. Now, inventory here includes raw materials, work in progress, and finished goods. Why do inventory include 3 kinds of things? Raw materials means a manufacturing company, it has to buy some raw materials. But then, say when the financial year is closed as on 31st of March, not all the inventory will be converted into raw materials. Not all the raw materials will be finished off. So there will be some raw materials in stock, some goods that are semi-finished. Now there might be some goods that are 100% finished, some goods that are 30% finished, some goods that are 50% finished. So these there might be 2 or 3 kinds of goods which might be in semi-finished conditions, which make up the work in progress, and there are might be some finished goods in stock which has still not been sold. So they kind of include 3 kind of things, both opening and closing, and prepaid expenses such as taxes and insurance. Now, for example, what are these kinds of prepaid expenses? Now, prepaid expenses, tax, such as you have paid, say, rupees 1 lakh tax as advance income tax, but however, for that particular year, your tax incurred is, as per your calculation, you have incurred 70,000. So 30,000 taxes prepaid. The taxes, insurance, for example, you might have paid in the insurance at the January. Your insurance period is from January to December, business insurance. But for this, you have paid for the current financial year, say January to March, and the prepaid insurances for the next year. So you have to take on the 3 months in this year's profit and loss account, at least will be carried forward in the balance sheet. Now, we can go to current assets. Further division of the current assets: cash and cash equivalent. The first kind of current assets are the most liquid. What do you mean by liquid? Liquid means the liquidity of any asset is measured by the time that it takes into to be converted into cash or its equivalent, or that is cash or bank. For example, we have cash and bank, and the or say investments, and we have say stocks or something like that, which we can easily directly sell in the market, and then we can recover the amount from the market itself. And now we also have accounts receivable. Accounts receivable is the amount that we obtain from from the credit sales to the customers. Now the credit sales, since in most cases the amounts are easily recoverable and recovered within a specified period of time, then this amount is known as the accounts receivable, and this is also considered as a very good source of cash, of cash for the company. Now, as we had previously said, and we have explained this in much more in details, we had said that inventory. Now, this is an investment that the company has made in raw materials, work in progress, finished stocks. Now, why are you talking about inventory? Because inventory actually it takes about more than 80 to 90% of, in case of manufacturing, 70 to 90% of the cost of a company's production charges and all that. So maximum cost is incurred in the inventory. So the company has to manage its inventory very properly, so that neither does it incur too much, nor does it has too less in the inventory. Because if it incurs too much cost, then it will have certain problems with cash shortage, or it might incur sharp loans. Sharp loans are certain loans that you have to take in emergency with very high rates of interest, such as overdraft and all that. And nor does it have extra or very extra amount invested in inventory. So means you have to balance the inventory portion. Prepaid expenses. These are expenses that the company has paid ahead of time. As discussed previously, this may be insurance expenses which have been paid, or prepaid taxes and all that. Now we have property, plant and equipment. These include land, buildings, machines, equipments and all that. Now some of these might be capital in nature, while some of this might be revenue in nature. Now current liabilities. In case of current liabilities, we have the accounts payable. Now accounts payable, like we have the accounts receivable in the assets category, that is people who have to pay us. As a business, you are also buying raw materials from someone, then maybe furniture from someone. These are accounts payable. Means from the permit generally, this include the people who have bought something from and whom you have to pay. So these are also known in case of on the asset sides, accounts receivable are known as sundry debtors. Accounts payable in this case are known as sundry creditors. Now these are the amounts for the bills which the company owns money to vendors or suppliers. Now in case of this, we have the bills. what are these bills, we'll discuss in the next class. This is all for today. Thank you.